why the yen is collapsing, and how Japan might fix it. Global financial markets are witnessing a dramatic shock at the heart of East Asia's monetary system. During the highly volatile trading session on June 19th, the Japanese yen, JPY, plunged sharply, approaching its weakest level against the US dollar, USD, in nearly 4 decades. At its most stressful point, the yen briefly fell to 161.8 yen per US dollar, nearing the historic threshold of 161.96 reached in July 2024. Should the currency break through this psychologically critical resistance level, Japan's currency would officially fall to its lowest value since 1986. Although the yen recovered slightly to close the week around 161.3 per dollar, following verbal intervention from Tokyo officials, traders in major financial centers, from New York and London to Tokyo, are increasingly preparing for the possibility of a direct intervention worth tens of billions of dollars by the Bank of Japan, BOJ. The turmoil surrounding the yen is far more than a simple exchange rate fluctuation. It reflects a profound divergence in global monetary policy and places Japan's economy in a strategic dilemma. Number one, the overwhelming strength of the US dollar and the Fed's interest rate shadow. To understand why the yen continues to lose value, one must first examine the extraordinary strength and dominant position of the US dollar in global markets. Over the past week, the US dollar index, DXY, which measures the greenback against a basket of 6 major currencies, surged more than 1% and reached its highest level in 13 months. The primary driver behind this movement was a series of unexpectedly hawkish signals from the Federal Reserve's latest policy meeting. Minutes from the Federal Open Market Committee, FOMC, delivered a significant blow to investor expectations for interest rate cuts. 9 of the 19 policymakers not only rejected the possibility of lowering borrowing costs, but also suggested that the U.S. economy might require at least one additional rate hike later in the year to fully suppress persistent inflationary pressures. The resilience of the U.S. economy, supported by a tight labor market and elevated core CPI inflation, has forced the Federal Reserve to maintain its benchmark interest rate at a historically high range of 5.25 to 5.50% for longer than previously anticipated. Expert perspective. Francesco Pisola, a currency strategist at ING, stated, "In the short term, the US dollar will continue to benefit from investor enthusiasm and capital reallocation following the Federal Reserve meeting. With US 10-year Treasury yields remaining above the 4.3% to 4.5% range, dollar-denominated assets remain highly attractive to hedge funds and global financial institutions." Number 2, the interest rate differential trap. Why BOJ's historic rate hike is still not enough. While Washington maintains exceptionally high interest rates to tighten monetary conditions, the Bank of Japan finds itself operating within an extremely constrained policy environment. At the heart of the yen's structural weakness lies the enormous interest rate differential between Japan and other developed economies. To its credit, the BOJ recently took a historic step by ending the negative interest rate regime that had been in place since 2016 and raising short-term rates to their highest level in 31 years. This move was widely viewed as a courageous attempt to normalize monetary policy after decades of battling deflation. However, from a macroeconomic perspective, Japan's new policy rate, currently hovering between 0% and 0.1%, is insignificant compared with rates above 5% in the United States and above 4% at the European Central Bank. This massive yield gap has fueled one of the most famous strategies in international finance, the carry trade. Global investors and financial institutions borrow yen at extremely low costs in Japan, immediately sell those yen in foreign exchange markets, and purchase US dollars or other higher-yielding currencies to invest in assets such as US Treasury bonds. This systematic pattern of selling yen and buying dollars, executed daily on a scale of hundreds of billions of dollars, creates relentless downward pressure on Japan's currency. As a result, BOJ's gradual interest rate adjustments have had little impact on reversing the broader trend. Number 3, the political confidence crisis, Prime Minister Sanae Takaichi's spending agenda. Beyond global financial forces and interest rate differentials, the yen has also been weakened by growing domestic political and fiscal concerns. Investor confidence in Japan's economic outlook has been shaken by controversy surrounding Prime Minister Sanae Takaichi's proposed large-scale government spending program. Having assumed office at a time when Japan's economy urgently requires stronger domestic growth, Takaichi has advocated an ambitious expansionary fiscal agenda. The plan would inject trillions of yen into semiconductor development projects, energy subsidies for households, and national defense capabilities. However, according to analysts on Wall Street and financial commentators, increasing government spending at this moment is highly risky and potentially conflicts with the BOJ's efforts to tighten monetary conditions. Greater public borrowing would worsen Japan's already severe fiscal deficit. The country currently carries public debt exceeding 260% of GDP, the highest among major developed economies. Even more concerning, additional fiscal stimulus could intensify cost-push inflation at a time when imported commodities, including oil, natural gas, and food, have already become significantly more expensive because of yen depreciation. The lack of coordination between expansionary fiscal policy and cautious monetary tightening has created uncertainty among investors. Many fear that Japan could lose control over both inflation and public debt, accelerating capital outflows and further weakening the currency. Number 4. Japan's high-stakes intervention gamble. With the yen threatening to break through 4-decade lows and inflict severe damage on businesses dependent on imported raw materials, financial markets are anxiously awaiting Tokyo's response. According to reports from sources familiar with the matter, Japan's Ministry of Finance, MOF, in coordination with the BOJ, is preparing contingency plans for direct foreign exchange intervention. Such intervention would involve deploying portions of Japan's vast foreign exchange reserves, primarily US dollars, to purchase yen in an attempt to reverse the currency's decline. Japan is no stranger to such operations. During April and May 2024, Tokyo reportedly spent more than $62 billion, approximately 9.8 trillion yen, to support the currency when it approached the 160 yen per dollar level. Yet the effectiveness of direct intervention remains highly controversial among economists and market participants. Interventions may provide short-term psychological support and temporarily discourage speculative activity, but they rarely alter long-term trends when fundamental macroeconomic forces, particularly the US-Japan interest rate gap, remain unchanged. Japanese policymakers now face a difficult strategic gamble. If they refrain from intervening, a move beyond 162 or even 165 yen per dollar could significantly increase living costs, weaken domestic consumption, and damage industries heavily reliant on imported energy. On the other hand, spending tens of billions of dollars in foreign reserves to fight broader market forces could deplete national financial resources without achieving lasting success. Such actions could also attract criticism from G7 partners concerned about potential currency manipulation. Conclusion: an uncertain future for the yen in the emerging global order. The sharp decline of the Japanese yen toward its weakest level in 40 years during the June 19th trading session is not a random market anomaly. Rather, it represents the clearest warning yet of the structural contradictions embedded within Japan's economy in an era of fragmented globalization. Japan's commitment to maintaining low interest rates in order to support its enormous public debt burden and stimulate an aging economy has unintentionally transformed the yen into one of the primary casualties of the US dollar's overwhelming strength. In the months ahead, the yen's future will depend largely on two factors: the pace at which inflation cools in the United States and the willingness of the Bank of Japan to accelerate monetary normalization. Without a fundamental shift in policy thinking from both the Japanese government and the central bank, the yen may continue its painful search for a bottom. And the currency's long-standing reputation as a global safe haven asset may gradually fade into a distant memory within the history of international finance. What is the way out for the yen? Japan's revival strategy and the critical lessons for the global monetary system. The currency crisis that has driven the Japanese yen, JPY, down toward its weakest level in 4 decades, hovering around 161.8 yen per US dollar in mid-June, is no longer merely a short-term technical fluctuation on foreign exchange screens. Through the lens of macroeconomists and international economic strategists, it is a clinical symptom revealing deep structural damage within an economic model trapped by 3 powerful forces: an extreme divergence in monetary policy, chronic fiscal deficits fueled by record public debt, and the most severe demographic aging crisis in modern history. As the currency of the world's 4th largest economy loses its traditional status as a safe haven asset, a domino effect is beginning to shake the foundations of the global financial system. For Japan, halting the yen's decline is a battle for economic survival, one aimed at protecting national purchasing power and retaining capital flows. For other major economic regions, from a stagnating Europe and a fiscally challenged North America to a youthful and rapidly expanding Southeast Asia, it serves as a powerful warning. The essence of the problem is not simply about buying or selling billions of dollars in the foreign exchange market. Rather, it concerns a comprehensive strategy encompassing growth, demographic structure, and a new generation of regional cooperation capable of anchoring economic stability amid global currency storms. Hamshar 1. What must Japan do? The 3-pronged strategy to break the yen's downward spiral. To rescue the yen from its free-fall trajectory, the government in Tokyo and the Bank of Japan, BOJ, can no longer rely on isolated foreign exchange interventions, such as the more than $62 billion spent during the second quarter of 2024, which amount to little more than temporary relief. Japan requires a comprehensive, coordinated, and decisive strategy, a 3-pronged arrow targeting interest rates, immigration-driven labor reform, and high-productivity technological transformation. Step 1. Accelerate monetary normalization and restructure public debt. The immediate reason behind the yen's persistent sell-off is the enormous interest rate differential, exceeding 500 basis points between the United States and Japan, which fuels global carry trade speculation. While the BOJ's decision to raise rates to their highest level in 31 years, around 0.1%, was historically significant, it remains largely symbolic. Required action. The BOJ must boldly accelerate its path toward policy normalization by raising benchmark interest rates to approximately 0.5 to 1.0% during upcoming policy meetings, despite the risk of increasing government debt servicing costs. Complementary fiscal measures. To ease the burden of public debt, which now exceeds 260% of GDP, Prime Minister Sanai Takaichi's administration must strengthen fiscal discipline, phase out inefficient, broad-based energy subsidies, and redirect resources toward projects capable of generating direct economic returns. A strong monetary tightening signal from the BOJ, combined with credible fiscal restraint from the government, represents the only effective medicine for narrowing yield differentials and undermining the incentives of hedge funds that continue to short the yen. Step 2. Demographic breakthrough. Open the door to large-scale immigration. The yen's decline also reflects diminishing investor confidence in a shrinking domestic market. With citizens aged 65 and older accounting for 29.1% of the population and the workforce projected to decline by 1/3 by 2050, Japan cannot sustain long-term growth while maintaining a largely closed labor market. Required action. Japan must fundamentally reform its visa and residency framework, replacing the controversial technical intern training program with a formal labor immigration system that offers clear pathways to permanent residency for skilled workers, particularly in healthcare, construction, and logistics. Japan should aim to attract at least 500,000 net immigrants annually through 2040 to offset demographic decline, rebuild domestic consumption, and reverse structural economic stagnation. Step 3. A productivity revolution through artificial intelligence and advanced automation. As labor costs rise and imported raw materials become more expensive due to yen depreciation, productivity becomes the only sustainable weapon available to Japanese businesses. Required action. The Japanese government should redirect public investment toward the comprehensive digital transformation of the economy, especially within the service sector and among small and medium-sized enterprises, SMEs, which continue to lag technologically. The integration of artificial intelligence, autonomous robotics, cloud computing, smart agriculture, and digitally connected supply chains can help Japan maintain technological trade surpluses even when physical manufacturing faces challenges. Japan must position itself as the world's leading exporter of automation solutions, transforming its labor shortages into a competitive advantage built on mastery of advanced technologies. Number 2, lessons for Europe: avoiding the trap of long-term stagnation and fiscal fragmentation. The European Union, EU, particularly the Eurozone, shares many macroeconomic characteristics with Japan: rapidly aging populations, economic growth below 1% annually, and heavy dependence on imported energy. Without proactive reforms, the euro could eventually face pressures similar to those currently affecting the yen. Managing policy divergence within the Eurozone. The European Central Bank, ECB, regularly faces a difficult balancing act. It must set a single monetary policy for 20 countries with vastly different fiscal conditions, from fiscally disciplined Germany to highly indebted economies such as Italy and Greece. Preventive strategy. The ECB should strengthen anti-fragmentation mechanisms to prevent excessive divergence in government bond yields across member states. Meanwhile, Southern European countries should use periods of manageable interest rates to implement structural reforms and reduce public debt toward the Stability and Growth Pact target of 60% of GDP. Europe must avoid stagflation, a scenario in which policymakers are forced to cut rates to stimulate growth despite persistent inflationary pressures, potentially triggering currency depreciation similar to Japan's experience. Addressing demographic decline through labor integration. Europe is also confronting rapid population aging, particularly in Germany and Italy. Unlike Japan, Europe already receives substantial immigration flows, but has often struggled to integrate newcomers into high-productivity employment, resulting in welfare burdens and political tensions. Preventive strategy. Europe should transition from passive refugee intake toward a selective economic migration model. Significant investments in vocational training, language education, and international credential recognition would allow immigrants to enter labor shortage industries more quickly. Maintaining a healthy ratio between workers and dependents remains essential for preserving the long-term strength of the euro. Number 3, lessons for North America: the risks of monetary dominance and the public debt time bomb. The United States currently occupies the peak of global financial power. A strong US dollar, supported by the Federal Reserve's restrictive policies, continues to outperform most major currencies. Yet, from a long-term macroeconomic perspective, this dominance may conceal a fiscal time bomb potentially larger than Japan's. The threat of massive public debt and twin deficits. US public debt has surpassed a record $34 trillion and continues expanding at a pace exceeding $1 trillion every 100 days. America has been able to sustain this trajectory largely because of the dollar's role as the world's primary reserve currency, allowing the country to finance both budget deficits and trade deficits through debt issuance. Preventive strategy. Washington must recognize Japan's lesson. Once market confidence breaks beyond a critical threshold, even the largest economies can lose control over their currencies. The United States should establish a credible long-term fiscal framework, reduce structural deficits, and gradually lessen its dependence on Treasury issuance to finance consumption-driven spending. If the dollar's privileged position is abused indefinitely, global de-dollarization efforts may accelerate, prompting capital flight from U.S. assets as investors begin questioning America's long-term fiscal sustainability. Sustaining real growth instead of financial bubbles. Much of America's current economic strength is tied to Silicon Valley innovation and speculative capital flowing into equity markets. This creates the risk of a dual-speed economy in which core manufacturing industries become hollowed out due to high domestic operating costs. Preventive strategy. North America should intensify onshoring and nearshoring initiatives through programs such as the CHIPS and Science Act. Building a robust manufacturing base maintaining leadership in foundational technologies, and preserving demographic vitality through high-skilled immigration are essential to ensuring that dollar strength reflects genuine economic fundamentals rather than a temporary byproduct of high interest rates. Number 4. Lessons for Southeast Asia. Maximizing the demographic dividend and building currency defenses. Southeast Asia, ASEAN, has emerged as one of the brightest growth engines in the global economy, attracting significant foreign direct investment as supply chains diversify. However, the yen's turbulence and the strength of the US dollar have placed regional currencies, from the Thai baht and Indonesian rupiah to the Vietnamese dong, under pressure from depreciation risks and imported inflation. Maximize the demographic dividend before it disappears. Countries such as Vietnam, Indonesia, and the Philippines currently enjoy favorable demographic structures, with large working-age populations supporting economic expansion. However, this demographic window will close within the next 15 to 20 years. Vietnam, for example, is already among the world's fastest-aging societies. Preventive strategy. ASEAN economies must move beyond growth models based primarily on low-cost labor and raw material extraction. They must rapidly improve education systems and transition toward higher-value industries such as semiconductors, renewable energy, advanced manufacturing, and the digital economy. The ultimate objective is simple: become wealthy before becoming old. Build currency defense mechanisms and next-generation regional cooperation. Given the volatility of the US dollar and other major currencies, individual Southeast Asian countries lack sufficient foreign exchange reserves to withstand a full-scale currency crisis independently. Preventive strategy. ASEAN should strengthen and expand the Chiang Mai Initiative Multilateralization, CMIM, a regional financial safety net worth hundreds of billions of dollars designed to provide emergency liquidity during balance of payments crises. Promote local currency transactions, LCT. ASEAN members should reduce dependence on the US dollar in intra-regional trade by expanding cross-border QR payment systems and local currency settlement frameworks. When Vietnam, Thailand, Indonesia, and Malaysia trade using their own currencies, they substantially reduce exposure to exchange rate risks arising from Federal Reserve policy decisions, creating a more autonomous, resilient, and shock-resistant regional economic space. Conclusion: a blueprint for a sustainable financial system. The yen's crisis is not an isolated event. It is a warning signal for economies across the globe. It demonstrates that in a deeply interconnected world, no nation, regardless of wealth or technological sophistication, can remain economically secure if it allows structural weaknesses in fiscal management, demographic reform, and regional cooperation to persist. Japan's experience shows that modern infrastructure and past economic glory cannot preserve a currency's value when national vitality is gradually eroded by demographic decline and policy stagnation. To avoid repeating Japan's mistakes, Europe must pursue meaningful fiscal reform, North America must confront its growing debt burden, and Southeast Asia must rapidly move up the global value chain while its demographic advantages remain intact. The future economic order will not belong to countries whose currencies appear strongest because of short-term interest rate advantages. It will belong to economies that successfully balance real productivity growth, demographic vitality, and durable regional cooperation networks capable of withstanding the financial storms of the 21st century.